Well, good afternoon, everybody. I want to welcome you. I'm Wellington Pack, president of FHI Ventures, as well as head of strategy for FHI 360. It's an exciting few hours ahead of you. Someone asked me recently, they said, well, why are you holding this in a ballpark? And aside from it being a beautiful venue, I thought, and I said, well, what better venue than to bat around some ideas on a panel and have a few pitches. Rough crowd. Okay, we're off to a great start. Yeah, as a native Bostonian, I wanted to go with Fenway Park, but something about a World Series championship. All right. So we've got a great few hours, and what I want to do is maybe just start off at the top of the hour thanking a few folks. I want to first start with thanking our CEO, Patrick Fine, and the executive team leadership for all the support and getting us here. I want to also thank Ed Whitehorn. Where are you, Ed? Somewhere. Ed Whitehorn, the chairman, there, back there, chairman of the board for our FHI 360. I want to also thank the rest of the board members who are here. Also, Al Siemens. Al, where are you? There you go, Al. Okay, thank you. Our chairman of the board of trustees of the FHI Foundation, and again, some of the other trustee members who were with us today. So I also would be remiss in not thanking our ventures team. So Priyanka, Kiara, Hardik, Elena, Melissa, and I know I'm missing a few, Rachel with our communications team. So if we could give our folks a round of applause just to getting us to this point. Thank you. Today, by way of our agenda, we really wanted to do two things. We wanted to tee up a conversation around emerging issues in impact investing. And here I think I'm just honored to have those in the room who on one hand think in terms of net IRR and exit multiples, sitting in a rational conversation with folks who are thinking in terms of theories of change and RCTs. So it all will make sense. And so today is really a time to, on one hand, discuss some of the emerging issues, and we've got an esteemed panel that we'll introduce in just a moment, and really just hitting the tip of the iceberg, if you will. And then what we want to do is spend a little bit of time celebrating, if you will, a number of things. Number one, celebrating the innovative work that is FHI Ventures on the part of FHI 360, our parent organization. And for those of you who are just coming into the family, we are a human development organization, a large diversified one, with just under 5,000 folks in some 70 countries all over the world. And we work in areas of health, education, and economic participation and development. And so we're going to celebrate innovations, and part of that is mainly is to celebrate our FHI Ventures cohort. And we're celebrating 5 very important companies. And as we look at the sectors in which we play and the insights that we've been able to garner as an organization driving our thesis, we want to celebrate them and flow right into a reception where hopefully many of you will make new contacts and meet some new and interesting folks. With that, what I'd like to do is, and by the way, we'll hear again after our pitches from or presentations from our cohorts, we'll hear some closing remarks from our CEO and then flow right into to our reception. What I'd like to do, if I could, is just take a moment to talk about FHI Ventures to get us all on the same page. We have a simple mission, FHI Ventures. We are the impact investing subsidiary of FHI 360, and we both accelerate and invest in seed stage enterprises. We focus in terms of capital continuum and life cycle. We focus on the seed round, and we focus specifically on post-prototype, pre- and early revenue enterprises that are working in the areas where we have expertise and some know-how. And our impact thesis, distinct from our investment thesis, our impact thesis is simply this. We want to help entrepreneurs and all of their innovations go from one end of the so-called pioneer gap, crossing that chasm, and getting into the next stage. What do I mean by that? Well, many of you know in the investment community that many great companies that are not just about impact or only about finance, but about both, many of these great companies in our ecosystem find it hard to go beyond non-dilutive capital. innovation grants, awards. These are very important forms of capital, but many companies want to go beyond that. And what we're finding is that there's a so-called pioneer gap where companies are struggling on a number of different fronts to get to that next round of whether it's a Series A or Series B financing. And so what we do at FHI Ventures is simply to help de-risk companies. We invest in them. We provide an opportunity for them to scale with all the things that we provide, and hopefully set them up and help them really in the great work that they're already doing to be sustainable. And how do we do this? Our distinctive approach, there are a number of accelerators, incubators, impact venture firms out there. We think that we bring a measure of distinctiveness. And specifically, I know it's a little bit small here, but there are some screens that you can look at. We really provide a few key differentiators. One is, I mentioned our global platform. We're in just under 70 countries worldwide, and that helps us get into the ecosystem of entrepreneurship. And we all know that entrepreneurship is in many ways very localized. The other thing that we provide is, and no small thing, technical and vertical or sectoral expertise. So whether it's in health, again, education, areas of economic development, we have reach-back capability into the parent organization to provide that kind of help that entrepreneurs need. And we've had a great run this past year in providing the right kind of help at the right time. We also have a sister organization, the FHI Foundation, and really here the kind of help, aside from being part of the broader family, is specifically around getting us to the table, getting ventures to the table based on the network, the platform that the FHI Foundation has been able to provide. And the foundation has its own track record of innovation and impact investing, if you will, before it became a term in vogue. And so we've been able to come to the table, if you will, with other potential investors, foundations, family offices that are wanting to engage in some way. We also provide, from a ventures perspective, what I would call value creation. So we have a team of folks, many of whom are former management consultants, and leaning in and asking, what is that would make your company more valuable, whether it's in looking at your business development, your operations, your HR strategy, and so on. And by the way, we've partnered with a number of folks, and this is the last bullet here, strategic partnerships. And I want to just highlight the formal partners in the room who've helped us get to this point. So the Global Development Incubator, GDI, where are you folks here? Yeah, we got some colleagues from GDI who have served as coaches and helped us with strategic thinking around how to best run this accelerator, working directly with our cohort. The Duke Innovations in Healthcare. Where are you? There we go, Malcolm in the back there. So a tremendous partner, not only of Ventures, but FHI 360 overall. And we also want to thank, there are a number of other partners at the table, and Duke's program at the Fuqua School, Kathy Clark is here. She's one of our panelists, but bringing to bear some of the tools that the program that Kathy runs, the CASE program, in terms of capital raising, smart capital, and that's been an instrumental tool for our cohort. So with that, what I want to do is also very quickly talk about how we got to this cohort. We start with and I won't read all of this, but basically a thesis that says we're wanting to make investments that are equity-based or quasi-equity, so convertible notes. We have provided capital, ticket size being $100,000, and over a period of 6 months, helping the accelerator, within the accelerator program, helping the cohort advance in some key areas. I'm very proud of one thing that I will highlight here, that on the front end, what was very important for us from a ventures perspective was to have an inclusion lens. And so I'm proud to say that even though we've gone from, we only have five really awesome companies. We started with well over 80 to 100. We diligence them like all funds and accelerators do. I'm very proud to say that 80% of our cohort has a female founder. And on the senior leadership team, 80% also have people of color, and that was an important inclusion lens as we work through our thesis. So with that, with no further ado, what I'd like to do is very quickly, and this is just, I forgot to talk about this, we are, from a ventures perspective, wanting to engage with many of you And with some of you, we have already been talking about the next round of investments, whether it's in a fund vehicle or in the next cohort in the accelerator program. So happy to talk to many of you who are already interested or would be interested in talking about that. What I want to do is introduce, with no further delay, our moderator for our panel. And Aaron Betru, as I mentioned, he is one of our Board of Trustee members. He's also the Managing Director of the Center for Financial Markets with the Milken Institute. Please help me in welcoming Aaron and the panel.
Thank you, Wellington. So good afternoon, everyone. As Wellington said, my name is Aaron Betru. I'm the Managing Director for the Milken Institute Center for Financial Markets, but also proudly a board member of the foundation and a trustee that is very much a huge supporter of FHI 360 as well as FHI Ventures. We're excited to have this discussion because I think we want to kick off this point around the intersection of commercial investments and social impact in a meaningful way. And what we're hoping to do is push the discussion into a realm where we're talking about what does it mean to push impact investing into the future, and where are the new market opportunities for different investors. And so what I wanted to do is share a chart that we had profiled at a Milken Institute event with a whole bunch of private equity investors, impact investors that were still looking at each other, and philanthropic investors, and trying to say, what are you talking about? And so we tried to distill, essentially, when we were talking about the intersection of these worlds, it's a very hard thing for anyone to understand which thing is more impactful. Is it more impactful to invest in women and girls? Is it more impactful for an investor to think about it in the context of the environment? Is it more impactful to just say health? We all have our theories of where really the greatest impacts come from, but from an investor's perspective, when you start layering in this social impact lens, there's kind of a personal story when you make that decision that becomes rather hard to inject and force someone else to believe in. So we said, let's take a step back from that and let's actually just understand the how part of this. And can I get the first slide up? Essentially, the way to think about this in what we call our impact investing continuum, on the extreme right from what you guys are looking at, what we've been calling direct investments. This is the traditional way that everybody's been seeing this. Essentially, you find a specific project and you're providing a direct investment to this thing. It's essentially a tailored offering. I'm supporting a discrete element. It's very attributable. I know exactly what the social outcome of that is going to be, but it's also a lot of infrastructure that's required to get that to the end stage. This is where essentially the accelerator function becomes rather critical in converting a social idea into a commercial venture. This is what I would say was impact investing, 20, 30 years ago, and still is a big part of it today. I want to go to the extreme left-hand side of what you're looking at. This is where the trends that is happening in the space, largely driven by the millennial sector. Essentially, everybody's trying to find impact in their non-discretionary portfolios. When I'm buying a mutual fund or I'm investing in a fund, I'm sure most of you heard Larry Fink at BlackRock make a claim that he's looking for impact across the board. This is one of the largest asset management. It is the largest asset management firm in the world. And so the question in that scenario is they're trying to find things that is already scalable. They're not looking for, something that is a drone technology for in sub-Saharan Africa. It's essentially green economies, it's health. It's something that is rather big, but not as specific as some folks want. And this is where, essentially, call it your gateway drug for impact investing. This is the space that we're starting to see more and more happen. And then there's things in the middle. Essentially, how are you going to find investors that do have a thing that they want to support, but don't have the infrastructure around them to find discrete things? Are there platform plays, middlemen, if you will? And there's a wide swath there. There's a UBS created something called Align 17. So this is a platform play for ultra high net worth individuals to find specific deals, and it's just a technology platform. Essentially, it's crowdfunding for impact investing. And there's a bunch of those that are out there. In fact, the US government has now entered into this foray. The BUILD Act, that was providing equity authority within OPIC to be able to actually be a conduit to bring institutional markets to find impact investable deals in the developing world. There's other reasons why they also are doing that, but essentially it's a platform play in the middle. Some way, all the various different players, they're somewhere on this continuum, some variations of it, there's permutations and whatnot. But at the end of the day, we're trying to find the intersection of more commercial capital with traditional IRR calculations, to what Wellington said, to things that are scalable but also socially impactful. Fortunately, I can say we're lucky to have a bunch of pioneers on the stage that are going to simplify everything and actually provide a perspective of where they're seeing impact investing today, but where it's going into the future. And so with that, I'd like to just take a second and allow each of you to, I'm not going to even pretend to know all the accolades that you have, so I'm going to say take a good 60 seconds and provide a little bit of context of name, organization, and its involvement in the impact investing space, and then we'll come back to a little bit of the Q&A. Why don't we start on the opposite end and then come back?
Joan Seifert Rose. I'm with a group called Launch Bio, which is a nonprofit partner of a group of co-working spaces called Biolabs. I am probably the least impact investing traditionalist in this room. And partly what I want to talk about today as we get into it is how perhaps a more conventional venture, private equity-backed idea is now starting to converge with impact investing. So right now I'm based here in North Carolina. I work with a co-working space that has 30 life science startups about a half a mile away from here. It is part of a network that is home to 300 life science startups, all of which potentially could be of interest to impact investors.
Fantastic. Hi, everybody. I'm Kathy Clark. I am faculty director for CASE, the Center for the Advancement of Social Entrepreneurship, and our CASE I3 Impact Investing Initiative, 10 minutes away at Duke University's Fuqua School of Business. I have been an impact investor for a little more than 25 years. And have been trying to basically build the field and marketplace of impact investing during that time. At CASE, we are a research and education center that trains the new generation, does research, and works to improve practice. And so we're delighted to be here today.
Hello, is this working? Can you hear me?
Yes.
Oh. So I'm Catherine Burnett, and I am the Chief Impact Officer of Phillips Enterprises, which is a family impact platform. That's a little unusual. It's probably one of the first such organizations that is led by millennials. The Phillips family is currently under millennial leadership. The two principals are in their 30s, and they inherited their responsibility for the family's wealth when they were 24 and 25. So they are really the tip of, or the beginning ripples of a tidal wave of wealth transfer that is happening in this country. And I think what's interesting for people is to look at them as a case study for what the future is going to look like. This young couple, they said, we did not make this money. This was grandfather's, but we are stewards of it. And we are responsible for having 100% of these assets drive positive change. So we can talk more about context in a little bit, but just that's a little bit of the big picture.
Thank you for that. I think, Kathy, I'm going to start with you. 25 years, okay. So when you're looking about your experience, essentially, there's something to the effect that efficient markets are when you have good supply of investable deals as well as good demand for that. In looking in the past, what did we get right and what didn't we get wrong? What didn't we get right in terms of the impact investing space, and what are the takeaways of that 25 years?
In a few minutes? Okay.
I'll give you 5.
You give me 5. All right. That's a tough one. I think there's some things that we're definitely getting right. When you look across, I have a kind of, I loved your chart. I have a value chain kind of picture in my mind when I think about the impact investing space. And so actually just came back from SOCAP where Fran Siegel and we do an annual, this is our 5th, so not 25, but 5, kind of state of the field. And we divide the field into the supply side and the demand side, and we talk about the trends in each. And on the supply side, we have just a tremendous amount of activity and traction, right? So if you divide the impact investing marketplace into kind of the publicly owned side and the private investment side, we have some incredible numbers going on. So the GIN estimates that annual increases in impact investing in the private markets have almost doubled every year for the past 5 years. It's now over 114 billion. Which is nothing to sneeze at. The public side of the market is perhaps even more impressive. The US SIF studies the amount of money that is invested in the US stock market that is screened for some sort of socially responsible purpose. When I started paying attention to those studies about 10 years ago, it was 1 out of every $7 in the US. As of last week, it is 1 out of every 4. So a quarter of the professionally managed assets in the U.S. are now screened for some sort of social responsibility, which is not necessarily the same as full impact, but as you said, it's the gateway drug. And so you gave context to that, which I love. So on the supply side, we just have an incredible amount of people saying, I want to put money into this, and I'm going to ask the professionals who manage my money to do this. The question is, where are we putting that money? And are we putting it into impact in ways that are sustainable and scalable and are actually addressing the problems that we have? And on that, I would say we're doing less well. There's a lot of us, including most of the people in this room, who care a tremendous amount about this. So I know we can do better. But when you look at the ease at which enterprises who have some sort of, are either working in an impact area that we recognize like health or education or financial inclusion, or are articulating real goals around those areas. There's a recent study that just came out of the Aspen Network of Development Entrepreneurs saying that they are actually having a harder time getting money. So we have this very strange thing where we have more and more supply, and we have a harder climate, perhaps, for some of the entrepreneurs. And from the, you mentioned millennials, we have, and universities, we have so many new ideas, right, coming out. But there's a gap, and that pioneer gap in the middle that Wellington talked about is very real, which is we have a lot of capital going into the shiny new thing. And it's usually grant capital, and you can give them a prize, and you can give them, you can feature them in your school paper, and that's all very fun and well. But then when you actually try to say what's investable, right, there's a gap there. And what we believe is there's kind of 2 reasons that this gap exists that we can work on. One is the conditions that the capital is actually looking for are quite constrained. It is not all the same capital, right? Capital comes with what kind of vehicle, what geography, what is the person who's put it into that vehicle promised their investors, right? So there's usually 5 or 6 kind of what we kind of call knockout criteria for any impact capital that needs to find its way into the marketplace. And for any particular entrepreneur, there may be only a handful, even though the supply is bigger. Right, so that matching thing. The second thing that we found, so in addition to my academic hat, we ran an accelerator for 5 years here in Durham, but we worked with entrepreneurs around the world. And what we found was those entrepreneurs, they were very sophisticated, but they didn't always understand what the conditions were of the capital that they were getting and how it would either propel them or hold them back from doing their dual objectives, which is growth and impact. And so we became really concerned about this, and it was one of the impetuses for us to create the Case Smart Impact Capital platform, which we've now entered into a partnership with FHI Ventures, and so we're really happy about that, to realize that this is a much more complex world for the entrepreneur than most investors appreciate. So when we went out, just like one more minute, when we went out to build this toolkit and said, well, what do we have to, what do entrepreneurs have to understand to raise capital well and get a deal that actually works for them? We said, well, how many different vehicles are there? And you named two, Wellington, right? Equity and convertible. We actually have 13 in our series because there's 13 different vehicles that people are using and they all have different constraints. Most investors don't even, I've been an investor for a long time. I didn't know about all of them. And so there's a load on these entrepreneurs to figure out how to do this right. And that's what needs to happen. Both parties need to understand what's the right tool for the job to get it done.
This point on kind of the dual goal of essentially growth but also impact, how difficult is it in your mind to actually make sure that the entrepreneurs that are coming across your threshold are actually focusing on both? From an investor's perspective, clearly, I'm interested in both, but definitely growth matters.
Growth certainly matters. I think, again, I was a foundation investor and then became an angel investor and then ran a small fund for a while. So I've done it from different perspectives and have been teaching social enterprise for over 25 years, this is the issue, which is at the enterprise level, what are you doing? What are you doing differently? How are you making changes around what you might be learning about your impact or your growth? And what do you do when there are friction points between them, right? What do you have to manage differently as a result of that? I think the answer is you can, but you have to be aware of what it is that you're committing to do, and you have to understand what is the pattern of growth that you want to be on and that your stakeholders agree that you're on. And that's where it came down for me. This is overly simplistic, but for me it came down to there's kind of equity level growth, and then there's everything else. And the constraints of venture capital and equity level growth, and I know we have some equity funds in the audience today, it's a very specific kind of growth pattern that kind of fund must choose to invest in. And many of the ventures, especially in developing markets, who are either trying to figure out what a customer needs or then starting to scale what a customer needs when maybe that customer is a low-income customer or there are other issues in distribution, you may not be a high-growth venture. And so to me, one of the most important things is recognizing that and helping both the entrepreneur and the funder understand what they're committing to.
Joan, I'm going to ask you to react to that because what I heard is essentially readiness matters. Essentially, these different ventures being ready for the next stage of capital, both under whatever the 5 metrics that are the knockout elements. You at Launch Bio are right in the center of that in terms of helping these entrepreneurs that you've dealt with, but with a much more commercial lens. And now that you're crossing into this realm, so
it's really interesting listening to this conversation because in many ways I think those of us in the healthcare sector and actually drug discovery have found their way into the social impact space almost by accident. And the reason for that is that, so I'll give you background. So as I mentioned, Launch Bio is a nonprofit partner to a network of co-working spaces. In those co-working spaces, up to 300 companies that are working on drug discovery and therapeutics. The initial idea behind this was improved capital efficiency. So that appeals to investors. So the idea is that companies can come in and grow much more quickly. They don't have to rent a lot of space. They don't have to buy a lot of equipment. They can work on their science. Well, the initial folks that were attracted to this model were your traditional private equity investors. And then there were some pharma partners that were interested. And now we're finding that this is also a very capital efficient model for foundations that are interested in curing or finding new treatments for particular diseases. So last week, Wellington was one of the speakers on our panel. We have some partners in the room that helped us with this. We had 9 nonprofit disease foundations come to Durham to talk about how they're doing deals and how they're finding these companies. And what we've realized is that the criteria that they are using to look for ways to partner and accelerate the pace of commercialization or the pace of creating new products that can benefit their patients, well, that looks a lot like a traditional investor model. But the outcomes they're looking for are different. So interestingly enough, one of the biggest questions that we got when these foundations were coming into town to meet our companies and to meet our network is about syndication. So how do you do a deal where you are marrying impact, where you're looking essentially to have a better outcome for a patient that might be improved through investing in a company. And we are talking about investments in companies. Most of these foundations have been giving grants for many years, but now they are moving into the impact investing space. They are putting in equity, they are doing risk investment, they are co-investing with others, and that is a new step for many of them within the last few years. So their real question is, how do we play in this world? Yes, we really like the capital efficiency that this model is providing us, but how do we work with a pharma or a venture fund that also wants to put some money in? And how do we possibly come up with outcomes that everybody can feel we are, getting something out of and that align with the values? At the end of the day, I think that these, from what we saw, these nonprofit foundations are really interested in playing in this space, but they just don't quite know yet what that looks like. And I think they're looking for help from all of us to figure out how to make that work. I'm excited, though, to see this. I've always been interested in impact investing, and to see that we're now moving into this space in sort of a more traditional healthcare, health discovery field, to me feels like a really interesting development. And I also want to give a shout out to the Milken Foundation for having done Faster Cures, where many of these foundations have been talking to each other for years, and many of them came up with this idea of starting impact investing funds because of the conversations you helped lead.
I'll say you're welcome. Clearly, there are thousands of folks or hundreds of folks in our headquarters that are way more responsible for that, but thank you for that shout out. Where's the special sauce in your mind between that shared service model with regards to the ventures, or the shared services model for the foundations, the investors? Where do you think is the special sauce?
Oh, I don't know. I think that everybody's trying to figure it out. I suspect that there will be, various experiments. I have talked to a number of the foundations who, for example, said they got 90% down of the way on a deal with a venture fund, and at the last minute, things just didn't work out. Sometimes they want to make an equity investment, but they need to do debt financing instead. I don't know. I mean, I think that we are still waiting for that great example of a collaboration to see how these two worlds marry. We occasionally have some examples of foundations that have gone it alone, or gone in with other foundations, or gone on in with a grant program and then had a great exit, but we just haven't seen that much happening in this world yet. But I know there's a real active interest in it, and I suspect that we will start seeing some new vehicles emerge, maybe some new ways of creating an entity where both groups can invest into to make an investment into these companies. And I just think we're into a new world and a new source of capital that's coming into these enterprises. And I will also say, as you talk about too, younger scientists that are working in this field are eager to work to see a real difference from the research that they're doing. And so I think they welcome these discussions as well, and knowing that they're going to make a difference in the life of patients.
No, thank you for that. I mean, it's rather interesting that you articulated this point around essentially creating better linkages in a quote-unquote supply chain or value chain. And Catherine, I'd love for you to react to this, because you host a very interesting dual role, both in terms of being the head of impact investing for a for-profit entity that's attached to a foundation where you're the head of the foundation as well. So in trying to think about that dual responsibility and creating linkages within Philips Enterprise, I'd love to hear your thoughts on how a corporation is doing it.
Sure, thank you. And I guess I should give a little more information about that. Philips Enterprises is the impact platform, as I mentioned, of the Philips family, and that encompasses a number of operating businesses, mostly real estate and a family office, and then various philanthropic entities, including the family's collaborative philanthropic entity, Philips Foundation. And so we really do look at I have several different business cards and think about which hat am I wearing right now, and sometimes need to switch halfway, and sometimes we can find opportunities for collaboration between the entities. But I think when we, there are a couple of different ways I can approach this question. I think I'll start with the foundation's perspective. The foundation, when we move to 100% impact invested assets, that gave us a lot of information that has helped inform our strategy for the investing the family's liquid assets through the family office, and also thinking about strategy through the company. At one point, we had a grant. We actually no longer make grants. We only make PRIs now for the purpose of catalyzing more capital and amplifying our impact to a larger degree. But back when we did have grants, we were working on a grant to end chronic homelessness in Guilford County. And a really key component to that was to have places to rapidly rehouse chronically homeless people, to provide wraparound support services to help them get back on track and become more stabilized and become contributors to society. And so as I was walking by the whiteboard outside of the largest operating company, and I happened to notice a vacancy rate on some of the properties that I thought would be really well positioned for us to house formerly chronically homeless people. So that was actually a really neat way to leverage, to have the family company provide at market rate, provide the housing that was then covered by grant funding from HUD, and then the foundation's support brought a collective impact model to Guilford County, where all 80 homeless serving organizations were tapped into a data system where they could share information and use their resources more efficiently and effectively. And then we, together with the family company and with the foundation, started moving forward to put together a social impact bond to scale this model statewide. And so I think there's some, and ultimately, we were able to decrease chronic homelessness in Guilford County over 3 years to 3 individuals. So I think there's a lot of power in using for-profit and nonprofit to collaborate together and think about impact. We really think about impact. We consider grants impact investments. They happen to have a negative 100% financial return, so they're maybe not the most lucrative, but we really look at the entire continuum, and I think that's one of the benefits of working for a family with these various different assets. We are able to come up with creative collaborations that can really move the needle on issues.
You raise a couple of things in your answer. Essentially, one, it's not an easy thing to find that intersection of financial returns and social impact. You have to look at your full suite of different issues. You talked about the HUD grant that you were dealing with. Essentially, when public policy actually works in your favor, it's something that's important for folks to consider. I want to change gears for a second and actually ask the folks to react to something that's a new development in terms of how potentially impact investments would go in the U.S. How many of you have heard of opportunity zones? Wow, okay, that's more than I was expecting. Well, for the rest of you, you're sitting in one. So we are in a piece of land that has been designated, quote unquote, as an opportunity zone. This stems from a recent development in the tax laws that were passed in this past December. Essentially, out of the 1,000 pages, there was 5 pages that did 2 things. First, they introduced the right for each of the governors of the 50 states, plus all the territories in the district, to select up to 25% of their low-income census tracts. If I could get the next slide, actually, just as an overview. What it did is it created these zones. They are low-income census tracts throughout the nation, roughly 8,700 of them, and it was 100% opt-in for the entire nation, including roughly 97% of the island of Puerto Rico. That's one thing it did. The second thing that it did is it actually created a series of efforts that would lead to a tax benefit, all based off of capital gains. Essentially, if you are someone that is sitting on unrealized capital gains, whether it's real estate or stock, and let's say you sell it today, you would be given 6 months to put it into something called a qualified opportunity fund. What this does is, as long as it is investing 90% of its assets into an opportunity zone, you as the taxpayer get automatic deferment of whatever you sold today to 2026. You get a reduction in the taxes that is based off of how long you're stayed invested in the fund, roughly reductions of taxes of 10 and 15%. And then the third benefit is if you stay in the fund for 10 years, any new gain in the fund is 100% tax-free in terms of the new capital gain is tax-free. So for all the investors in the room, let's just say you can take a 9% IRR business and then turn it into a 15% after-tax IRR. So this has become a very powerful tool that a lot of people in the U.S. are starting to lean in and figure out if they make investments in opportunity zones, what would they do? And essentially, majority of the interest in this has been in the real estate space. And so this is something I'd love to hear your reactions in terms of, as a real estate operating company that Phillips is, how are you guys thinking about taking advantage of opportunity zones? And a lesson to be heard by some of the entrepreneurs here in terms of being companies located in opportunity zones.
Thanks so much. That's a great question. And actually, we're looking at the opportunity zones as an opportunity from all three of our units. So from the real estate company, looking at the company develops and manages multifamily housing and are expanded into some other areas as well, industrial and commercial real estate and single family homes and townhomes. But for us, we're looking at some of our properties are in opportunity zones and they need to be repurposed. But then that brings up the ethical dilemma of, well, if we reposition them, are we then gentrifying the area and pushing out the very people who opportunity zones are supposed to be helping? So we're carefully examining opportunities, and but bringing the impact lens again, as the family are stewards of this wealth and want every dollar to make a positive difference. We can't make people homeless. It's certainly not in alignment with our work. And then from the family's family office, we are looking at capital gains, tax benefits. And then from the foundation, we're actually looking at guaranteeing opportunity funds that would make them more attractive to investors, particularly in areas that might have a harder time attracting investors, maybe some of the rural areas, some of the smaller cities. If we can provide guarantees, then investors will be more likely to invest in those areas, knowing that if something goes wrong, we would ultimately bail them out.
Just for a little bit of clarification, so from an investor's perspective, they have to just make an investment in what is a qualified opportunity zone property. So that property can be actually a business or can be real estate. It's just, think about the context of, somebody that's sitting in a very wealthy neighborhood, billions of dollars of gains, realizing the opportunity in something that's in a low-income neighborhood across the country. It's just easier to look at real estate. However, there is a big push to actually spotlight ventures that are located in zones. And so, Kathy and Joan, I'd love to hear your thoughts on what do we need to do to make sure that this goes to job-creating ventures rather than gentrifying neighborhoods.
I think this is a really interesting opportunity for the people who care about impact, because what opportunity zones have done is enlarge the conversation to anyone who can benefit from a capital gains deferment, right? So it's a much more heterogeneous group than people who think about impact for a living. And if you talk to, I have some friends at law firms, and they're saying, suddenly half their business now is giving people advice about this. And what it makes me think of, and you were saying, well, it could be a business, it can be real estate. What it makes me think of is some of the conversations that we went through in the early days when we were developing the standards for B corporations, which was, what part of this business actually has the potential to have impact? And how do we articulate that? And how do we compare businesses, in terms of what they're doing? And I think the opportunity zone conversation is a little bit of the same conversation, which is, if you are a real estate development inside this zone, what are you doing that's impactful, that an impact investor would want to support, or bless as you're getting your tax credit, right? And the same thing's true at a business level. Is it jobs? Is it something else that they're doing inside that community? Are they using all the supply chain locally? You could imagine, again, the laundry list of the 256 things that we asked B corporations to answer. I think it's a great opportunity. I don't know if other people are thinking about it that way. What I do see in the marketplace is other impact investors, especially foundations, saying we have the opportunity to raise the bar a little bit and to as you were saying, Catherine, and to show some good options. right? So if you do care about impact and you also want to get this credit, here are some better places, right, to put your money that you can be assured, because not everyone is going to be able to do all the diligencing and vetting to make sure that over the long term, this investment is not actually harming this community.
No, thank you. I think you raise a good point. Essentially, there is something like $6 trillion of unrealized gains in this country, and as people are starting to look, it's going to behoove the rest of us to provide the actual investable opportunities, and then you'll find a very new group of individuals that maybe they came to the table just for their capital gains, but they'll stay for the impact. And with that, I actually wanted to bring the audience into this conversation. You've got some pioneers on the stage. Love to get a little Q&A going for the last 10 minutes of this conversation. So if there are any questions, we've got folks walking around with microphones. Please raise your hands and share. I've got a question. So we're looking at how hard it is to go beyond that non-dilutive capital to more commercial capital. When you're looking at essentially the entrepreneurs that are either part of the FHI Ventures program or new ones that are thinking of coming in here, if they had a choice to be made by essentially thinking in advance about the venture that they're doing versus the financial engineering around their venture and bringing different types of capital to the table, what would you recommend that they focus on?
Can you repeat the last two sentences?
Between financial engineering to get the returns for investors versus getting the business concept clean and simple. What's more important?
I think it depends on the stage that the entrepreneur is in. I don't think any entrepreneur can start by saying, I'm going to be a 12% return business. They're going to fail. They need to start by saying, do I have a customer and do I have a product or service that that customer is going to be delighted with enough to pay what it costs me plus something, right? And that's the early work. That's the blueprint work of trying to figure out whether you can get that engine to happen. Then I think you end up learning things that tell you over time, and sometimes it's quick and sometimes it takes a long time, you know, what's the scale of the growth that you can do in that business. And then other financial options occur to you, you really want to jump in. So I'm going to let you.
I do. So I would just say to the entrepreneurs, like, there are so many different kinds of capital. So do not trade off your impact. That is the most important. And there are funders like us who will pay concessionary rates and will be willing to concede upside in order to help make sure that your venture can make a difference in the world. And we will, obviously those will be PRIs, they'll be out of our 5%, but do not trade off impact for it in thinking about how you're going to make this work financially, because there are funders who can show up at the table with a lot more flexibility.
And I'll just say also for early stage, you know, many of the companies that we deal with are pre-revenue forever. And so one of the true. And one of the things that really is true is, you know, how well you manage the money that you have. So I think there's a lot about really understanding that the money that you've been given is to accelerate your growth and to use that wisely, and that is going to be the thing that investors will look at to help get you to that next round. To ultimately, you will find a partner, a buyer, you know, you'll find some exit, but because scientific investigation is such a long process before you really see some returns, if at all, managing capital efficiently has really got to be at the top of the list. And you can't imagine what your outcome is going to be. I mean, I would not even begin to say, oh, we're going to, you see the hockey stick, right, projections, right, you know, well, 15 years out, we should be making 30 times, no, sorry, that's not going to work. So just focus on the business, focus on the science.
Great. I think we have a question back there.
Yeah, I'd like to ask a question about management teams. I come from the venture capital world and like, and a VC will very quickly fire the founding team if they've picked the wrong horse. And I guess the question is, in the impact investing world, are you guys going to do that, or to ensure the success of the venture? And how do you deal with that that part of the gap between the two worlds?
The impact investing world is at least 11 different kinds of investors, and I would say private equity is one. And so the answer is yes and no. There are investors who will decide that the horse is not the right one for the commitment that they've made, and there are investors who will support and nurture. And there are investors who will do both at different times. So it's just too generic a question for an extremely diverse set of actors, if that's okay.
And I think, again, just and then I see there's another question back there. Thinking about what is the source of the capital. So for us, if it's a market rate investment, there's a little less flexibility than if it's a program-related investment where it's concessionary. But we do tend, and maybe it's just with the impact lens, we tend to invest in people and who have great ideas and who have a track record of being able to deliver results. And so and it may just be the family's lens, but we don't trade horses. We invest in people.
I really like your answer, Catherine, better than mine, because what you showed was it actually depends where the capital comes from and what the constraints are. And so if you've raised a fund for a certain amount of return, which is what venture capitalists do, you are forced to try to get that return to happen, right? But if you're a foundation investor, if you're an individual, so we know individuals who have multiple pockets, right? And they can kind of do whatever they want with the pocket they have, and they can switch pockets halfway through if they decide to.
Yep. Yeah. I think there was a question right here, and then we'll go to the back. Yeah. Please tell us your name and where you're from. Yeah.
It's not working.
It's,
You just press the button again, see if it turns green.
Actually, kind of a blending of the last several questions, but from the investor perspective, I'm curious. It seems like a dilemma of serving two masters, so both the social impact and the financial return. And I'm wondering if the smart and successful investors who try to find that balance do so at multiple points along their engagement with the portfolio company or defining that portfolio of companies, or if they stage that. For example, is the social impact element a criteria for initial selection of investments, but at that point then it becomes drive hard towards financial returns with the assumption, the premise that when those companies are successful, they will have a positive feedback into social impact. And therefore there's sort of a staging instead of always a simultaneous trying to strike that balance between the two. Does that make sense? Yeah. Does anybody?
Yeah, sure. So, you go ahead. Okay. So I think for us it's simultaneous. We won't consider an investment unless there is that really strong social impact. But then again, depending on what pocket we're investing from, we have different criteria for what is required financially. But for us, and it probably differs individual to individual, but for us, we won't consider something unless there's the social, but then the financial is right up there with it.
That was exactly my point. Essentially, you'll find a lot of investors that have that more or less industry screen that is a social impact component, but by all means, this is not meant to be a subsidy at forever. It is meant to find some sort of financial return. They might trade off a little bit in terms of maybe I'm not looking for something that is triple-digit returns. I'm willing to take something a little bit less for the social impact, but it is not at all meant to be a subsidized play forever. There are different pockets of money that go into that, but in this unique space, it's making sure folks realize that you have to do both.
And I just want to add too, and Rob, I think you know this just from the Biotech Center work, that in the health research space, especially through the disease foundations, many of the contributors are high net worth individuals who in the past have been approached to make investments directly in companies. In many ways now they are looking to the mechanisms that the foundations are setting up to do that screening process for them. So increasingly now you will see, as I say, as foundations start to make more direct investments in companies, they are hiring people with venture experience from the VC world. They're putting together teams that look very much like traditional due diligence teams, and they look at the sorts of, like I said, the outcomes they're looking to arrive at are somewhat different. But I think that this is one of the trends that I'm seeing, where in the past you might have gone to a particular wealthy family and say, would you make an investment into my company? That's now becoming more professionalized, and I think you're seeing that the foundation stepping into this role, and then presumably also that they will be expected to have both returns so they can make additional investments, but also achieve the outcomes of better results for patients.
I think there's a question in the back there.
Yes, thank you. Heather Shawnee with the FHI Foundation, and it's kind of a nice segue into the last question, because I wanted perhaps the panelists can talk a little bit about blending these different tools, because Kathy Clark, you mentioned that there's 13 tools available, so it isn't just an equity or debt play, but there's actually different layers that can come in. And I think particularly with institutions like, Catherine, the Phillips family, and even our own FHI Foundation, FHI Ventures, this wonderful global organization that is the deliverer of social impact. How do you maybe mesh these different tools together to create that ecosystem and kind of de-risk those other more traditional investments?
So I'm going to say, since the panel time is almost over, why don't you weave in that answer with your final comments, and we can I'll allow, perhaps start from this end and go down.
Sure. So thinking about blending capital in order to reach our impact goals, in some cases we do look to de-risk. When I was mentioning the guarantees for opportunity zones, we think that's a really important aspect of our work. There's one example that might be helpful for people when we think about, we work with an organization called MCE Social Capital, and they are essentially a merchant bank, and they get commercial funding to then fund MFIs and DFIs around the world. But what they do is get guarantees from donors. So they have about 1.5 times all of the assets that they have that have been deployed to social entrepreneurs. They have about 1.5 times in promised guarantees. And that actually allows the banks, the commercial sources of funding from which they're getting the funds that they need to do their work, to A, come on board at all, and B, provide funds at a much lower rate. So I think I don't know if that's helpful, Heather, but, and then for my final comment is really just this space is growing so quickly and so beautifully, and it's amazing to see all of these people in this room who are bringing value to this ecosystem building. And I think it is just on the up and up, and really such a pleasure to be here. Thanks.
So we did a study 4 years ago of high-performing impact investment funds, and we didn't look at all of them, but we looked at a subset, and then we narrowed that to diversify. And then we looked at what some of the common characteristics were across them. And this idea of layering different kinds of capital together, we called it catalytic capital. And we found that about 1/3 of the high-performing funds in the marketplace as of 4 years ago had that as part of their structure. Our definition of high-performing, by the way, was not just on financial return. It was met or exceeded investor expectations on both financial return and impact return, impact expectations. And what was interesting to us is we ended up creating almost kind of a development model where we realized that there were some funds who always wanted to have some de-risking capital as part of what they do, because they were trying to address extremely hard to reach populations with entrenched problems. And then we saw that there were other funds that actually used, often it was either nonprofit or foundation money or government money, to be the catalytical layer either a loss guarantee or a lower subordinate layer, to allow a bank or another non-dilutive player to come in with confidence. And with several of those funds, they were able to do a second fund or a third fund without the layering. So it was actually a process of de-risking a market where everyone's like, you can't make money on that. And they're like, let us show you. And then once they did, you don't need that stuff anymore. And that's a wonderful, we thought that was a wonderful way of seeing the progress through the marketplace, and how you can actually move from funds that are blended rate funds into completely market rate funds. And it's basically a perception gap, right? That you're countering. You're not doing anything differently. So if you're interested in more of that, I can refer to that. The final comment I would make is we've become really interested in the last 6 months or so in some of the attention that's being paid around the world by multiple institutions to gender lens investing, which is another area where this blended finance is really becoming very important. And I just wanted to mention that we are doing a program in March, a 2-day program here in Durham on gender lens investing, and we'd love to have any of you be part of that as we study what's being done and help people to become, kind of in 2 quick days, how do you get the basics under your belt so that you can actually put the money to work.
And just for me, I'd say that new conversations are happening in this space all the time where I sit. In addition to millennial investing, really expecting more from the type of commitments they're making to advanced technology. We're seeing a whole group of successful tech entrepreneurs entering medical research space as well, and these are folks who have the ability to come in and write a check very quickly and expect things to move much faster than things normally do in the medical research space. So I would just say worlds are colliding, and that's what I think the future looks like, and I think that there's lots of opportunity and many things that probably we'll sit here a year or two from now, we'll be talking about new types of investment vehicles and new partners that are coming together to make impact.
Yeah, thank you for that. Now, I'll take your thread in terms of the worlds colliding and take moderator's prerogative in adding to this blended finance point. So essentially the guarantee space is something that the Milken Institute has looked very deeply into. And actually, when we talk about structuring and blending different types of capital, even within guarantees, there are good guarantees and bad guarantees. What we ended up doing with my co-author, who's sitting over there, raise your hand so you get some credit too. There he is. Essentially looked at 80% of the guarantee market that's done by bilaterals and multilaterals, and found that the way that folks write these guarantees, they don't actually work for most financial entities. They're filled with conditional elements. They are not tradable in 30 days. Essentially, they don't provide the same balance sheet relief. And so in terms of colliding both policy and innovative financing, there's, I would say, impact investing that we are experiencing today is nothing like what it was 20 years from now. And the worlds are definitely colliding, and I would say in the next 10 years, it'll be very different than what we are experiencing. And with my final comment, I'll ask, who are the investors in the room that are looking to make an investment probably in the next 6 to 12 months? Can I get a show of hands? Who are the investors out there? All right, so all the entrepreneurs, that's where the money is. And with that, can I get a thank you for panelists and hands?
Catherine, Kathy Clark, as well as Joan. Really appreciate the great insights on innovative financing trends in emerging markets and in the U.S. I'm Priyanka Rao. I am the principal of FHI Ventures. Ready to kick off the next part of our day, and I think this might be one of the next exciting parts of it. So I've had the privilege of working very closely with our inaugural cohort of companies, 5 companies doing some great innovative work in the U.S. as well as in global markets as well, in emerging markets. We worked in the past 6 months very closely in an accelerator program. We're calling the Social Enterprise Facilitator Program. It's virtually based, and they focus very closely on business plan refinement, capital raising, and impact management in coordination with a lot of our mentors at FHI 360, external advisors, and dedicated coaching as well, services from Global Development Incubator, and of course leverage our K-Smart Impact Capital tool as well. So On that note, let's start to hear some great pitches from our 5 companies. So 6 months ago when we launched FHI Ventures and the companies got to present on their business and services itself, we asked them to pick a song that they identified with and to enter the stage. So we're going to keep with that theme because a lot of you, I know a lot of familiar faces who were there 6 months ago, but I think it'll be a fun way to really get to know the entrepreneurs and what they identify with in terms of music. So on that note, I'll start with Eddie Agbo from Fyodor Bio.
Hello there. You probably heard that I'm a survivor. Well, I'm Eddie, and we are Fyodor, the biotech company that makes it possible to test for malaria in minutes using a few drops of urine. Indeed, I am a malaria survivor, and with a PhD in molecular genetics and years of academic research at Johns Hopkins University, I've spent the past 8 years with my team to create the urine malaria test, the first take-home test for malaria anywhere in the world that requires no blood, no reagent, no equipment, and works just like a pregnancy test. You see, if you don't remember anything I said today, just remember that malaria is a pretty bad disease. And research have shown that it may have killed about half the people who have ever lived. Think about this for a moment. And now this. The disease is pretty easily treatable if diagnosed early. Fever is an early sign of malaria, but there are several other causes of fever. So early diagnosis within the first 48 hours of fever onset makes the difference between life and death. Now, delayed diagnosis, on the other hand, rapidly reduces the chances of survival from 100%, remember I said it's treatable, from 100% to 50%. Every year, about 516 million laboratory blood tests for malaria are performed in clinics worldwide. That's about over 500 million laboratory blood tests. With the UMT, we are changing the narrative. Now, no need to go to a lab to draw blood. We bring the lab to the patient, and we are democratizing malaria testing. How does this work? I mentioned earlier it works like a pregnancy test. You simply take, the cups come in the kit, so take the cup, add a few drops of urine, and dip the stick in the sample. Let it stand for about 25 minutes. If 2 lines appear across the strip, as you see here, the test is positive for malaria. If 1 line appears, which is the control line, then the fever is not due to malaria. Compared to microscopy, which was identified in the 1880s, and rapid blood tests, which was introduced by Becton Dickinson in 1976, the UMT is a single-step test, requires no technical expertise, and the overall cost to the patient and the health system is much lower. The bottom line is we are increasing access to testing for malaria and expanding the malaria diagnostic market. And that is new. The innovation has already been, we received regulatory and marketing approvals for the UMT in Nigeria and Liberia, both of which constitute about 30% of the malaria diagnostic market in Africa. And we have implemented a limited market beta test in Nigeria where we delivered about 200,000 units in pharmacies. And this will be of interest to you. So these units we introduced, there was no marketing effort, and they were all gone in 6 months with no marketing effort. So imagine if we can back this product up with a major marketing push. That's what we're trying to do right now. So we are now ramping up our production. We're building a winning sales force, and we are ready to move on full steam ahead. Over the past few years, the FHI and the UMT have won innovation prizes, especially the Innovation Prize for Africa, more recently the MedTech Innovation Prize in Paris. It's also been profiled in Harvard Business Review as one of Africa's new generation of innovators. So we're excited about that. Our team includes individuals, each with at least 10 years of relevant industry experience. Leslie comes with an MBA from Wharton and spent over 25 years in medical devices as well as auto industry, in corporate strategy and marketing. So that's a big asset. Amaka is a general manager for sales and marketing and actually has the ground game for medical devices, consumer goods, and pharma marketing, product marketing in Nigeria. That's very critical. I introduced myself earlier. Of my 19 years in research and academic and industry, I spent the past 13 in the biotech sector. So, in closing, I want to invite you to join us to scale the UMT in the marketplace and expand the malaria diagnostic market so that never again will anyone die from malaria because it was not detected early. That is the power of the UMT. So we have a stand here, and I invite you to come talk to me if you want to pee on a stick. Thank you.
So next up is Mark Labs with Kevin Barrow, who's the CEO.
So for the allocators of impact capital, the world has changed. Gone are the days of sentimental charity, and almost certainly gone are the days of sentimental aid. Outcomes achievement, measurable impact, social impact bonds, paying for what actually works. These have become the new norm. Whether you're dealing with an organization which is distributing millions in the form of investments or grants, or you're speaking to the organizations that are desperate for that capital in order to survive, measuring and being conscious of your impact, and especially your impact data, has become incredibly important. My name is Kevin Barrow, and I started Mark Labs with the goal of organizing the world's social impact data and making it accessible and useful. Now, at Mark Labs, we help our customers maximize their impact by transforming their data, much of which was underutilized, uncollected, or simply overwhelming, into an asset. Why do we do this? Because we believe that impact data has the potential to transform the way that we deal with impact capital, to make it possible to allocate impact capital and other resources at scale in a manner which is strategic, coordinated, data-driven, performance-based, and making sure that they get to the organizations which are doing the most to transform and advance society. Sounds really easy, right? Not really. And the reasons for that are many. But when you think about it, in the United States alone, we allocate countless billions every year in impact investing, in over a third of a trillion by ordinary citizens, just in the form of philanthropy. And yet we fail to move the needle in a manner that is commensurate with the amount of money, time, and other resources which are being allocated. Why is this? Because the problems that people with impact capital have in identifying the who, what, where, when, and why of impact capital placement and management. And this is where our platform enters. We have built Gnosis, an impact management platform which helps our customers track their impact investments against impact achievement. If this is where we started, our platform alone would be a gift to the ecosystem, but that is just our starting point. We've added to this exponential technologies that allow our users to be able to extract even more value from their data. We make it possible to bring alternative data sets and through data mining and public data to the data sets so that you're able to understand your investment in context. We make it possible through social impact, through blockchain technology and smart contracts to drip release your funding conditioned upon KPI reporting. Of course, we make it possible to collect your proprietary data, organize it, understand it, see it, and communicate it better. But then we use artificial intelligence to be able to engage in predictive modeling so that you can actually see into the future at the programmatic and at the ecosystems level what is the change that your investments are actually driving. The benefits for our users are manifold: reducing costs, increasing revenue, improving your operational performance. But in the words of one of our customers, it could mean the difference between relevance and going the way of the dodo bird. Now, when you look at our competitive landscape, you might ask a question. Why is it that companies like Barclays have sought you out? And why is it that they will continue to do so in the future? The answer is very simple. We've built an end-to-end platform which makes it easy for organizations to manage their investments in context from the programmatic level all the way through to the ecosystems level, permission-based real-time sharing of that data, and being able to, for the first time, track performance and track payments on the same platform. Now, when you look at the market opportunity, we have launched our platform with targeting customers that represent a $2 billion opportunity across socially conscious asset managers, impact funds, family offices, and foundations. But this is just our starting point in an ecosystem which has been radically growing over the last few years and is expected to continue growing at approaching 60% CAGR over the next 7 years. Now, the traction to date has been incredible, ranging from the who's who of the Fortune 500 companies to socially conscious family offices and foundations. I'd like to take a moment to actually talk about some of the applications. For companies like Barclays, this has been about getting a deeper understanding of the social impact that's being driven by green bonds. And it also has been a tool that Diane Eshelman, the head of their corporate social responsibility, said could help them to be more proactive in their CSR. A direct quote from her was that we spend £50 million every year on our social responsibility, and we don't know whether that number should be doubled or halved. This is not a problem which is unique to Diane Eshelman at Barclays. This is something which impact investors, which corporations, which organizations that are trying to bring social impact into their DNA have to wrestle with every day. How do we justify the investments and decisions that we are making so that we're able to substantiate it to our board, to our employees, to our stakeholders, and the communities which we serve? This is where our platform enters. Next Wave is a fund which specializes in investing in women. They are using our platform to actually map out their ecosystem of investors and inviting other impact investors to participate so that they're able to better allocate their capital to women and track the impact of their investment portfolio over time. Our examples go on and on of how organizations are bringing impact into the daily operations of their organization, driving better decisions, better understanding and communicating the impact that they are having time and again. Now, the awards and honors that we've achieved over the years range from companies like the BBVA, the Spanish bank, which acknowledged our work for its application to the universe of microfinance, to the Rothschilds Foundation, which recognized the social impact implications in terms of development economics, and most recently from Amazon Web Services and others around the application of our technology, specifically in the development context in sub-Saharan Africa, and how this could be used as a means of eliminating and reducing waste, corruption, and fraud in the development sector. The team with which I have the privilege of every day going upon this Herculean task of improving the way that funds and capital are actually allocated for impact are definitely the wind beneath our wings. It's my wings, at least. Camille Jones is an experienced machine learning and blockchain expert, and Junaid Gori literally was a rocket scientist, worked at NASA, but also is one of a nationally recognized machine learning expert. What's next for Mark Labs? Well, we are poised for growth. Our 18 pilots with corporations across the United States and globally have poised us for our next round of commercialization. We are excited about where our platform is and are excited about where it is going and the change it is going to drive. We are also poised for impact. Not only are we working to make it more transparent and make it the impact which our organizations and partners and customers are using more accessible, but we're helping them to make sure that they stay relevant, that they stay competitive, and that they continue to transparently and with accountability serve the communities. Thank you for making the time. We are Mark Labs.
And next up is Sannovation.
Afternoon. My name's Emily Woods. I'm one of the co-founders at Sannovation. At Sannovation, we're working to create a world where everyone has access to safe and dignified sanitation. We do this through partnering with utilities to provide comprehensive sanitation services through market-driven, innovative approaches. We've been operating in Kenya for 4 years, and in that time, both I and my co-founder both received Forbes 30 Under 30 recognition. We've been ranked in Fastco's top 10 most innovative companies in all of Africa, and this year we even won the USPTO's Patents for Humanity top award. But one of the coolest things I've gotten to see was actually watching the US ambassador drink tea that was cooked off of one of our reuse materials that we make from human poop. The reality is that utilities around the world are struggling with rapid urbanization. Traditional approaches to sanitation only really include large sewer networks and wastewater treatment plants that are just too expensive for most emerging markets. And because of those barriers, 60% of the world's population are living in communities without access to safely managed sanitation. In Kenya, that number is even more outstanding. 95% of human waste is dumped in the environment without being treated. That means raw, untreated human feces ends up on food, in water, and on children's hands. In fact, untreated human waste is the second leading cause of child mortality worldwide. In Kenya, over 17,000 children die every year because of this lack of safely sanitation. Utilities in Kenya are soliciting for public-private partnerships for solutions to solve this problem. The demand is so big that the World Bank estimates that it would cost $50 billion annually to reach the Sustainable Development Goal for 100% safely managed sanitation. And the 118 secondary cities in Kenya, that's over 147 million in potential revenue for improved sanitation infrastructure. So how do we fix this problem? Well, at Sannovation, we realized that first you've got to change the way that you think about human poop. That if we consider that human feces actually has value, then it actually can be transformed into secondary revenue streams. So rather than just paying money to get rid of human feces, we can actually invest it in transforming human feces into something valuable that then can be sold to offset the cost of safely managing it. So Sanovation has a three-step approach. First, we offer sanitation services like citywide planning or container-based sanitation that helps ensure that waste is properly collected and transported. Then we use our patented technology to not only treat the waste, but transform it into a valuable reuse product, solid fuel. We then sell this charcoal and firewood substitute as that secondary revenue stream. In Kenya, there's a $5 billion market for solid biomass fuels. And our fuel burns twice as long and has 1/3 of the emissions of local charcoal. And beyond that, we save 88 trees for every ton that we sell. So by selling this fuel, we're actually creating a revenue stream. So we're making waste treatment plants that actually make money. Our treatment factories have already demonstrated a 55% gross margin. That's right, that's a waste treatment plant that makes money. And so we already have 3 factories in Kenya that are operating. They serve 20,000 people with safely managed sanitation and can produce 300 tons of fuel, of safe, sustainable fuel every month. With these factories, we already have an MOU from the local utility in Naivasha, with the government of the county government in Nakuru, and we also have had 2 contracts with UNHCR. And we're looking for expansion for next year. And the impacts of our work are outstanding. For livelihoods, not only are we providing 20,000 people with safely managed sanitation, we're actually employing 75 staff and creating a livelihood for those people in places like refugee camps and informal settlements and slums. In health, we've already removed over 100 tons of infectious, untreated feces from the environment, with research shows can have a 40% reduction in diarrheal diseases. And beyond that, this year alone, we've already sold 750 tons of our sustainable fuel, saving over 65,000 trees in Kenya. And because these impacts are so outstanding, it's estimated that for every dollar invested in sanitation, yields a $5.5 return on investment in productivity and health benefits, one of the highest of almost any sector. And so in the next 3 years, we're looking to expand to 9 factories and serving 1 million people with safely managed sanitation. So right now we're doing a raise in equity, grant, and loan-based project financing for some of these costs for this expansion in the next few years. So we're looking for people like you to join with us. We know that the global state of sanitation might stink right now, but we believe with Sanovation and our team, we really smell the prospect of scaling innovative infrastructure to a sector that's long overdue. Attention is needed. So thank you for your time.
Okay, so, still on Senate. Next up is Dexter Gauntlet from Sweet Sands.
Hello. Now my life is complete. So my name is Dexter Gauntlet. I'm the co-founder and director of business development for SweetSense Inc. SweetSense provides real-time monitoring of water points in emerging markets in order to improve service delivery, reduce non-revenue water, and improve health impacts. The pain in the market is very strong. The market that we're talking about is the one that many of you in this room are working in. See, the problem is that when water projects are funded, is about $40 billion per year comes into in the form of grants, loans, contracts in order for private entities, for NGOs to install water projects. But these water projects, typically in the form of pumps that serve either rural communities or 10 to 200,000 people in peri-urban communities, are non-functional 30 to 50% of the time. Many of these projects fail in the first 18 months. These are studies from the UN and from USAID in Oxford. So the question becomes, how do we align this intent with actual impacts? So SweetSense comes in, and we provide the technical expertise in the form of sensors and the deep domain expertise in the water and health sectors to help transform this current infrastructure-focused paradigm to one more focused on actual outcomes, to more around improving service delivery. We're looking to close this loop. We do that by installing our sensors onto water pumps, again, serving between 10,000 and 200,000 people in places like in East Africa, where we're currently monitoring water points serving 1 million people. We do it by providing access to dashboards to local water service providers, mainly utilities, local government, donors, whoever is involved in installing these projects. And then we provide the implementation support in order to improve the operations and maintenance systems, in order to increase revenue for those fledgling water utilities. We're really seeking to create a virtuous cycle where improved water service delivery increases revenue collection and therefore results in greater investment in that water infrastructure, and the cycle continues. Here's a peek at our dashboard of what our end users will use in order to dispatch people. So as you can see here, our sensors are monitoring a couple hundred sites here in northern Kenya as part of a very large project funded by USAID. And red means the water pump is broken. Green means it's working. We tell you how much water. Yellow means that there could be something wrong. We're working with blue chip partnerships with IBM Research, Oxford, London School of Hygiene and Tropical Medicine, Colorado University, Portland State University, in order to help us really quantify our impact. When we talk about the market opportunity, we're looking at about $140 billion that's needed in order to reach Sustainable Development Goal 6, which is universal access to safe water and sanitation. In addition to that, there's about a $2.8 billion a year need in annual operations and maintenance requirements. But that's a joke. That's not happening today. It's not going to happen if we continue along the same infrastructure-based paradigm. On top of all this, today there's $4 billion a year that is considered non-revenue water, which is basically revenue not collected by utilities as a result of leaky water infrastructure and inability to collect tariffs because of poor service delivery, right? Would anyone here pay for water if they only received it 4 to 6 months out of the year? No way. So we're dealing with a very systemic challenge here, but we're also gaining traction. We've been around for 5 years. We have significant contracts with AECOM, USAID, UNICEF, Millennium Water Alliance, and by the end of 2019, we'll be monitoring water points for more than 5 million people in East Africa alone. We also have a SBIR Phase 2 award for $1 million. That's going to help us reduce our costs and expand our business development presence and look at new partnerships around the connectivity piece of this, which I'd be happy to talk to you guys about after this. Swarm Technologies, Aris Communications, IBM Research are all very strategic partnerships for us, not only in the near term in terms of opening up new business opportunities, but also pathways to potential acquisition later. Like I mentioned, we're running a number of impact studies, and we've shown that use of sensors when teams are dispatched from the local water service provider, the utility, we can increase functionality up from 50% to over 90%. And again, as part of our NSF award for the SBIR, we're now working on predictive algorithms that can take that 90% and say that's not good enough. We're going to bring this up to 99 and 100%, where we can predict within 1 to 7 days when a water pump is exhibiting signs of failure, so you can preemptively treat the situation. This is what failed water projects look like. This is the challenge that we are trying to solve. I've got plenty more of these if you want me just to keep going here. In terms of competition, SweetSense is definitely playing a market maker role here. People don't even like to admit that this problem even exists, right? So we're out here doing the roadshow, trying to educate folks in DC, folks in the field, and we're actually gaining a lot of support from the right people. We're the only company who's providing the full suite, which is the sensor hardware, the software dashboard analytics piece, and the deep technical expertise of working in the water and health sector for more than 15 years on our team. Our revenue model of the future is $1 per day per site for real-time monitoring. We're going to sell this as a service where SweetSense will install, own, and operate the sensors, guaranteeing minimum uptime. And then we will add on additional premium add-on services around optimization of operations and maintenance models and other research kind of selling the data functions. Our team, led by Dr. Evan Thomas, who's a former NASA engineer, worked on remote life support systems for NASA, applying that kind of mindset into using data in the international development sector. We also have, he also started and sold another health and water-based social enterprise in the sector in Africa 5 or 6 years ago. Our field team is based primarily in East Africa, and our data analytics team, a couple of Berkeley PhDs in data analytics. Our board, we have an astronaut on our board, Ron Guerin, and Chris Ullum, who's a successful energy CEO. We really look forward to speaking more with you about this as we try to close the loop. Thank you so much.
And finally, last but not least, Giffen How do you say your last? Dottridge. From Sure. I always mess this up. Sorry.
It's not an easy one. A couple quick disclaimers. One, I didn't choose my song, Priyanka did, but she did a pretty nice job. The second one is that we also make urine tests, so forgive me if there's some recycled jokes and analogies in here. My name is Giffen Dottridge. I'm here today to talk with you about my startup, Sure Inc. We are addressing the issue of medication adherence, which is an incredibly expensive and deadly problem throughout the world. In the United States alone, it's estimated that medication non-adherence costs the system almost $300 billion per year and leads to 125,000 unnecessary deaths every year just because of people not taking their medications the way they're prescribed. The way Sure addresses this is by making urine tests that measure and improve medication adherence. We've done multiple studies to validate our tests. We have a lab test that is commercialized and being used by 5 customers. We've developed a prototype of a point-of-care test, which I'll pull out here. Again, looks just like a pregnancy test, similar to what we've seen. And we have multiple funders and public and private partners in place. Our team here has over 5 decades of clinical R&D and commercial expertise, and we've worked and studied at places like Harvard, Penn, McKinsey, and the Global Fund. The way Sure got its start is my co-founder and I are both doctors. She's an infectious disease physician, and we started a clinic in Philadelphia. In this clinic, we were providing an amazing drug called PrEP to young gay men of color. This drug perfectly prevents HIV if you take it every single day. Now, unfortunately, several of the patients in our clinic became HIV positive because they were struggling with adherence. And Michael was one of those patients. He became HIV positive at the age of 24, even though he was on a drug that should have perfectly prevented that infection. It happened because of non-adherence. And so when Helen and I thought about this issue and how do we make sure it doesn't happen again, we realized that non-adherence really boiled down to 2 major things. Number one, as providers, we didn't know who was and was not taking their medication. Patient self-report is very inaccurate and often overestimates actual adherence. And the other issue was our patients were not optimally motivated to take their drug. They would take it and they would say, you know, I don't feel any different. And as a result, over time, adherence would wane. So we decided to start Sure to make sure this didn't happen again. Our first product was a lab-based urine test that would measure the levels of the drug in the patient's system and allow us to diagnose objectively non-adherence. Additionally, our tests allowed the patient to see the drug was in their system at a level consistent with protection, which, remember, is a very powerful motivator for remaining adherent. The beauty of our tests is that they require no additional clinical visits and no additional samples. Patients are already coming in every 3 months and giving urine samples. We just take a small amount of that urine and use that for our adherence testing. And as I mentioned, we're also developing a point-of-care version of this test so that we can deliver these results in 10 minutes and counsel the patient during the clinical visit. This test, when we initially thought about it, we realized that HIV made a great initial commercial market. There are 21 million people worldwide taking this drug tenofovir for either HIV prevention or treatment. Unfortunately, suboptimal adherence leads to 1.6 million people still getting infected every year. That leads to about $37 billion in healthcare spend, and we estimate that just in the US, pharmaceutical manufacturers lose almost $500 million per year because of medication refills not getting picked up due to poor adherence. So as we think about Sure's business model, let's keep the payers and pharma in mind. In addition to HIV, we can use our tests for any disease and drug that you take over a prolonged period of time, because we often see adherence wane in those cases. Hepatitis C and tuberculosis are two that we have in our pipeline right now, but there are multiple other applications. The reason we love urine tests versus other methods for improving medication adherence are the following. Number one, a urine test actually allows you to see if the patient has ingested the medication. Self-report, which is the current status quo in smart pill bottles, don't actually measure that. Additionally, other tests for adherence, like hair and blood tests, are not as patient-friendly because they require a needle stick or a hair sample. They're not as friendly to the healthcare system because they're significantly more expensive, and they're not as friendly to the provider because they take much longer for them to return results. Again, our point-of-care test comes back in 10 minutes versus over 7 days for these other tests. Our business model is very simple. We sell tests to providers and clinics, and we get reimbursed through a billable code we've been assigned by the Center for Medicare and Medicaid Services, generating a 35 to 45% gross margin per test sold. To date, we have some great early traction with research groups at Drexel University, with the AIDS Healthcare Foundation, which is actually the largest HIV provider in the world, as well as with departments of public health in Houston, Washington, D.C., and Virginia. We're also targeting strategic partnerships with multiple pharmaceutical companies and diagnostics companies, and we have a number of supporters, both in funding and partnerships, already working with us. So we're at a very exciting time for Yersha right now. We have a product, we know it works, and what we're looking at now is how do we scale that up, which is really the exciting part. Our focus with funding that we're doing right now is to grow our internal BD operations, attract the commercial partnerships that can allow us to accelerate our scale, and ultimately bring multiple other tests to market. So if anybody in here is interested in working to eradicate some of the most common, deadly, and costly diseases in the world, I would love to talk with you. And I'd ask you to please remember that for preventing diseases like HIV, it can be as easy as 1, 2, P. Thank you.
Thank you, Giffen. So another round of applause for all of our 5 companies. They're all amazing, and it's been truly a pleasure for me and a privilege to have worked with all 5 of them and also connect them to our own FHI 360 ecosystem, who worked very closely with each other in ensuring that not only these companies get to leverage new markets and networks and resources, but we're working together to solve some important issues and problems around the world. So thank you, all 5 of you. And I look behind me and I see the sign of going places, and I think all 5 are going places, including 360 and Ventures itself. I know Wellington covered this up front itself, wanting to thank some of our strategic partners, but I want to take another moment to ensure that we are thanking some of our close partners through this past 6 months who really helped us get to this point. And we look forward to continuing our collaboration with all 5 of these entities, but also looking forward, working with all of you in the room to ensure that we can work together to build this ecosystem and supporting social entrepreneurs like our Fab 5 here, and continue to co-invest and partner for opportunities in the future itself. But more importantly, for right now, we want you to get your wallets out as much as possible. So investors, raise your hands up again. We want to know where you are so our companies know exactly who to go to. Of course, we'd love to follow up with you later as well. I know at the beginning when you all came in, you've all received a note card, and you've been asked to indicate your name and a company that you're interested in learning more about, investing and or partnering in. And if that's changed since you've heard these great pitches, make sure you meet one of our team members, Wellington, myself, Hardik, Kiara, and Melissa. We're scattered around the room. We'll be happy to give you a note card itself to update those as well. And then we'll follow up with all of you afterwards as well. So thank you again for coming. And before we get into reception and networking mode, we'd like to hear from our CEO, Patrick Fine.
Great. Thanks. The panel and the entrepreneurs knocked it out of the park. Thank you for that. What strikes me listening to these social entrepreneurs is that what we're listening to is the future. This is the future of addressing human development needs. I'm so happy that FHI 360 is a part of that future. We'll be looking forward to the coming year to identifying social enterprises that are as compelling as the ones that we heard from today, and I think that that is going to be a heavy lift on our team to finding enterprises that match what we heard today. We hear a lot about the fact that in the social impact field that there is a lot of supply, as Kathy said, but that demand, on the demand side, the enterprises themselves are finding it more difficult to actually find investment. If you're an investor and you heard these pitches, there is no excuse for you not to be able to deploy your capital into enterprises that offer the prospect not only of financial return, but of real social impact. Thank you all for taking your time to be here today, and please enjoy the reception.
Just one more thing. As we're looking to the future, we are also looking for new, we'd love to partner with you to continue to support new entrepreneurs as well. So come to us to let us know who else we can support. Thank you.